Welcome to Market Brief After Hours, where we break down the day's biggest financial stories and what they mean for your portfolio. We have a lot of ground to cover today. Wall Street closed sharply lower on Friday, wrapping up a pretty bruising week. It seems like a perfect storm of a tech sell-off, spiking Treasury yields, and surging oil prices. To help unpack all of this, I'm joined by our resident market analyst. Thanks for being here.
It's great to be here, even if the numbers we are looking at today are a bit grim. You called it a perfect storm, and that's exactly what it felt like on the trading floor. Investors were aggressively pulling back from technology shares, and those renewed inflation concerns really took center stage.
Let's dive right into the major indices because the numbers paint a very clear picture of that pullback. Let's start with the Dow.
Absolutely. The Dow Jones Industrial Average took a heavy hit, dropping 537 points. That is a 1.07% decline, bringing it to a close at 49,526. We saw investors actively reducing their exposure to those high-growth tech shares that had been enjoying weeks of really strong gains.
And the S&P 500 wasn't spared either, right? It had just reached record highs earlier in the week.
Exactly. The S&P 500 slid 1.24% to close at 7,409. It completely failed to hold on to those record levels. A big catalyst for that caution was the Trump-Xi summit. The market was really hoping for some major policy breakthroughs, and when the summit ended without any, risk appetite just evaporated. Add in the inflation fears and those elevated oil prices, and you get a recipe for a sell-off.
That brings us to the tech-heavy Nasdaq, which seems to have suffered the sharpest decline of the three.
It did. The Nasdaq Composite lost 1.54% to finish at 26,225. This was driven by a massive sell-off in semiconductor and artificial intelligence-linked stocks. These shares have been flying high, but they came under immense pressure on Friday.
Let's talk about some of the specific names caught in that semiconductor crossfire. Who were the biggest losers?
Intel fell more than 6%, and Nvidia lost 4.4%. AMD dropped 5.7%, and Micron Technology lost 6.6%. But the most dramatic move was Cerberus Systems. They tumbled a staggering 10% after having a massive rally just the previous session. When Treasury yields rise the way they did, it severely pressures sentiment across high-growth sectors like tech.
You mentioned Treasury yields. Let's get into the macro side of things, because the bond market was making some serious noise.
The bond market was screaming. U.S. Treasury yields surged as investors rapidly reassessed inflation risks and what interest rates might look like under the new Federal Reserve Chair, Kevin Warsh. The 30-year Treasury yield climbed aggressively, pushing above 5.1%. That is the highest level we've seen since May 2025.
And the shorter durations?
The benchmark 10-year yield rose nearly 14 basis points to hit 4.595%. Even the 2-year yield climbed close to 9 basis points, reaching 4.079%. And this wasn't just a U.S. phenomenon. We saw yields spreading globally. Germany's 10-year bond yield rose to 3.127%. The UK 10-year gilt yields climbed above 4.56%. And Japan's 10-year government bond yield increased 7 basis points to 2.69%.
Speaking of global impacts, the European markets had a very tough day as well. Can you break down what happened across the Atlantic?
European markets tumbled as inflation concerns intensified. Investors were reacting to hotter inflation data, those rising bond yields we just talked about, and higher energy prices. The pan-European Stoxx 600 fell 1.6%. Looking at specific countries, Germany's DAX dropped 2.1%. Italy's FTSE MIB lost 1.87%. And France's CAC 40 declined 1.67%.
I understand the UK also faced some significant headwinds.
Yes, the UK's FTSE 100 fell 2%. Mining and banking stocks suffered steep losses there. Antofagasta and Fresnillo both dropped more than 10%. On top of the economic data, there is brewing political uncertainty in the UK. There are reports suggesting Andy Burnham could challenge Prime Minister Keir Starmer for the Labour leadership, which really pressured market sentiment.
And you mentioned hotter inflation data in Europe. Where are we seeing that most clearly?
Italy is a glaring example. Their annual inflation rate accelerated sharply to 2.7% in April, up from 1.7% previously. That was driven by a strong rebound in energy prices and rising food costs. It really reinforced the fear that inflation pressures are building up again across the entire continent.
Let's pivot to Asia, because the numbers coming out of there were downright shocking, especially in South Korea.
Shocking is the right word. Asian equities weakened across the board due to those same inflation fears and heavy profit-taking in tech. South Korea's Kospi plunged an incredible 6.12% to close at 7,493. This was right after it briefly hit a fresh record high above 8,000 earlier in the session. Samsung Electronics fell 8.6% after its labor union confirmed plans for an 18-day strike, and SK Hynix lost 7.6%.
What about Japan and China?
Japan's Nikkei 225 dropped 1.99%. They had producer price inflation accelerate well above expectations, which has everybody worried about further tightening by the Bank of Japan. Meanwhile, China's Shanghai Composite lost 1.02%, and Hong Kong's Hang Seng Index declined 1.62% amid broad weakness across healthcare and technology shares.
Before we move on to the commodities and Forex markets, we are going to take a quick break. Stay tuned. We'll be right back with a deep dive into the currency markets and some incredible movements in gold and silver. Welcome back to Market Brief After Hours. Before the break, we covered the massive tech sell-off and the global equity slump. Now let's look at the commodities market, specifically oil, because geopolitics are playing a massive role right now.
Absolutely. Oil prices jumped sharply, and it was directly tied to geopolitical tensions. President Donald Trump warned that he was not going to be much more patient with Iran. That immediately stoked fears of further conflicts or disruptions in the Persian Gulf.
How did the crude benchmarks react?
Brent crude rose 3.35% to settle at $109.26 per barrel. West Texas Intermediate, or WTI, climbed 4.2% to close at $105.42. Whenever oil surges like that, it feeds right back into the inflation narrative that is spooking the equity and bond markets.
Let's transition to the Forex market. With all this volatility, the currency pairs must be showing some significant technical movements. Let's start with the euro against the dollar.
The euro broke lower following a period of consolidation. Euro USD closed at 1.1622, which is down 0.40%. Technically, this is significant because the pair broke decisively below the 50-day simple moving average at 1.1647. It's also remaining beneath the 200-day SMA at 1.1682 and the 100-day SMA at 1.1706. The short-term technical structure is definitely deteriorating, establishing a sequence of lower highs since mid-April. Immediate resistance is right at that 50-day SMA of 1.1647, while support is seen at 1.1617 before we hit the key 1.1600 psychological level.
What about the British pound? It sounds like it had an even rougher session.
It did. GBP USD slid sharply, finishing at 1.3317, down 0.63%. Sterling broke decisively below both the 50-day SMA at 1.3430 and the 200-day SMA at 1.3426. The 100-day SMA at 1.3481 is continuing to cap the broader structure. This sharp decline really signals growing downside momentum. Resistance is now seen at 1.3406, while initial support remains at 1.3315 ahead of the 1.3250 region.
Did any currencies manage to gain against the dollar, or was it a clean sweep?
The Swiss franc actually saw some action. USD CHF extended its recovery as buyers regained momentum. The pair closed at 0.7868, rising 4.0%. It pushed above the 100-day SMA at 0.7840 and reclaimed the 50-day SMA at 0.7865. However, the broader trend is still capped below the 200-day SMA at 0.7919.
And the Australian dollar?
AUD-USD suffered a heavy pullback from its recent highs, closing at 0.7148, down 1.01%. It posted a sharp bearish reversal after failing to sustain momentum above 0.7250 earlier in the week. But despite the sell-off, the price is actually still above its major moving averages, the 50-day SMA at 0.7089, the 100-day SMA at 0.7002, and the 200-day SMA at 0.6778, so it's preserving its broader upward structure for now.
Let's look at precious metals. Usually when equities fall, we look to gold as a safe haven, but that wasn't the case today.
Not at all. Gold extended a sharp decline, closing at $4,534, down 2.48%. The metal fell aggressively below both the 50-day SMA at $4,729 and the 100-day SMA at $4,786. Investors were actually liquidating their safe haven positions, triggering heavy selling pressure.
And silver? I saw the percentage drop and it looked like a total collapse.
Collapse is the perfect word. Silver settled at $75.79, down a massive 9.15% in an extremely volatile session. It broke sharply below the 50-day SMA at $76.97 and the 100-day SMA at $80.94. This aggressive sell-off erased much of the previous multi-week rally.
To wrap things up, let's look at some specific market movers. We talked about semiconductors earlier, but who else made headlines?
ARM Holdings was a major story, falling more than 8% to lead losses in the Nasdaq 100. Crypto-linked shares also took a beating alongside Bitcoin, which dropped to a 1.5-week low. Coinbase Global and Galaxy Digital both fell more than 7%. Mara Holdings lost over 6%, while Strategy and Riot Platforms declined more than 4%. We also saw dLocal slide more than 12% after reporting Q1 earnings of 14 cents per share, missing the 17-cent expectation.
Was there any good news out there? Any silver linings?
Yes, actually, Figma was a bright spot, surging more than 13% after increasing its full-year revenue guidance to between $1.42 billion and $1.43 billion. And on the macroeconomic front, U.S. manufacturing output increased 0.6% in April, beating forecasts, largely thanks to a 3.7% surge in motor vehicle production. Industrial production also rose 0.7%, and capacity utilization improved to 76.1%. So despite the inflation fears, parts of the U.S. economy are showing real resilience.
It will be fascinating to see if that economic resilience can challenge the broader market fears in the coming weeks. Thank you so much for breaking all of this down for us today.
My pleasure. There's definitely a lot to keep an eye on heading into next week.
Absolutely. And to our listeners, thank you for tuning in. If you found this useful, please follow Market Brief After Hours. We'll see you next time.